In this video, I'll explain exactly what is meant by real estate investing, and we're starting right now. Hey guys, Elliot here. So when someone says they're a real estate investor, or say they want to be, what do you envision? Perhaps they rent out a few homes or flip a property? Real estate investing is certainly that and a lot more. Let's take a closer look so you know exactly what the term actually means. Strictly by definition, real estate investing is any time you put money into some form of real estate with the expectation that you will eventually make a profit on it. Real estate is, of course, any house, building, structure, or land that is of beneficial use to someone. The two most familiar approaches to the average person are the buy, fix, and sell approach, also known as the fix and flip, and buy, fix, and rent approach. Let's go over each one. When you fix and flip real estate, you first acquire undervalued and underpriced property, typically a single-family home that may often be in some state of disrepair, and then inject significant value into it by renovating and improving the property. This can be just cosmetic in nature, such as a new paint job and new flooring, but often goes deeper with new kitchen and bathrooms as well. After the property is renovated, it is then resold or flipped for what is hopefully a significant profit. Flipping does take real estate know-how and some significant initial capital in order to find and finance undervalued properties that can also be renovated economically and for a profit. It also helps to understand home construction and renovation. Although most successful flippers don't do the renovation work themselves, leaving it to the contractors, the knowledge goes a long way in helping you price the work and check what your contractor has done. Flipping is considered a short-term capital appreciation investment. It is roughly analogous to buying stocks in an underperforming company on the cheap, holding it while the company restructures and returns to profitability, and then reselling the stock at a profit as it appreciates in value. The fix and flip investor has no intention of holding the property for a long time, only long enough to fix it up and realize a profit on the sale. The second type of real estate investing, the buy, fix, and rent approach, often starts out the same way as fix and flip. You are seeking out an undervalued and underpriced property that may need some light renovation, but once that is done, you're not going to sell it, but rather rent it out. You can also just get a move-in ready house to get cash flow going right away without having to fix anything. The idea in both cases is to hold the property for a long time, allowing the rent payments to pay off the balance of the mortgage with some money left over as a monthly profit. The investor gains from both the rental income and the capital appreciation of the property over time. This type of investing has its own unique challenges, mostly having to do with finding, vetting, placing, and occasionally evicting tenants, as well as dealing with landlord issues such as damages and repairs. It's definitely not for those investors who hate dealing with the public, and investors who own numerous properties typically end up hiring a management company for the day-to-day task of administering and operating the rental. This real estate investing approach is considered a long-term capital appreciation and cash flow investment, and it is roughly similar to buying and holding a stock that is not only projected to go up in value, but also pays out regular dividends. In terms of housing, the stock is the property and the dividend payments is the rent collected from tenants. So fix and flip and fix and rent are the two most common approaches to real estate investing for the average person, but there is a third way that is often overlooked, and that is wholesaling. Real estate wholesaling is somewhat related to the first purchase and flip approach. A real estate wholesaler is a middleman of sorts. They find undervalued or distressed properties where the owner may be in financial trouble and has not kept up maintenance. The wholesaler then approaches the property owner with a contract to sell. Next, the wholesaler reaches out to investors looking to acquire fix-up properties to flip and proposes the sale to them, but at a somewhat higher price. And the wholesaler's profit is then the difference between what the investors will pay and what the owner will accept. A wholesaler needs to not only have extensive seller and investor networks, but also the ability to precisely evaluate and price properties so they are attractive to both the seller and the buyer. Good wholesalers also have to be master negotiators to entice both parties to come to an agreement. One upside of wholesaling is that since nothing is actually purchased by the wholesaler, little to no capital is required up front. So the three approaches I just talked about mostly focus on residential houses. However, fix and flip and fix and rent can also be applied toward commercial real estate, or CRE, which is our fourth approach to real estate investing. Examples of CRE include office buildings, industrial property, medical centers, malls, apartment buildings, warehouses, and much more. An investor makes money from CRE with both capital appreciation and cash flow. Cash flow is typically rental income or leases, but may also include a percentage percentage of tenant earnings or other arrangements. Returns on commercial property can be in the 6 to 12% range, far higher than found in residential investing. CRE, though, is a complicated field because you are dealing with more laws, regulations, and red tape than with residential real estate. Many more attorneys, accountants, financiers, bankers, managers, engineers, and others typically have to get involved in any deal. The costs and ongoing expenses are far higher than residential as well because you're now dealing with potentially multi-floor buildings with thousands of square feet of floor space. For these reasons, commercial real estate investing is typically not a one-man operation, but it's certainly something an individual investor can get in on, especially if they are part of an investing team. There is, however, another way to get into commercial real estate, and that is indirectly by investing in organizations that invest in CRE. These organizations are called real estate investment trusts or REITs, and they are the fifth and final real estate approach I will talk about. Real estate investment trusts are major corporations that do nothing but invest in and manage real estate properties. These properties are almost always commercial in nature, as REITs don't deal with individual houses, but they may invest in residential holdings such as large apartment complexes. REITs issue regular stock and pay dividends, which come from the property lease and rent collections. As an investor, you can purchase and collect dividends from the stock issued by REITs, and this is one of the best and most affordable ways one can end up investing in commercial real estate. Okay, that was a quick discussion overview of several different approaches to real estate investing. As always, if you enjoyed this content, please do like and subscribe, and I will see you in the next video.